Today, we're going to dive into some major tax changes that former President Donald Trump is proposing if he gets elected again. Now, these changes could impact everyone from middle-class workers all the way up to big corporations, and even the prices that we pay for goods from other countries. So let's break it down for you. The first section that we're going to talk about is the proposals for the middle class, so the middle class tax proposals, okay? And we're going to talk about extending the Tax Cuts and Jobs Act. All right, so he wants to extend this from his previous term. Now, you may be saying, well, what is this act? Well, actually, this act early on lowered tax rates for many people, but actually those rates are set to expire next year. If that happens, guess what? Our taxes are going to go up. So let me break this down for you, what it looks like right now in 2024 if you're a single earner, okay? So these are the current tax rates. These are marginal tax rates. And right now, if you make up to $11,600 a year, this is your tax rate, 10%. If you make up to $47,000, it's 12%. Up to about $100,000, 22%. Up to about $192,000, 24%. Up to $243,000, 32%. 609.3. Anything under that is 35%, but if you make anything over $609,300, you're paying right now 37%. Now, if the Tax Cut and Job Act expires, all of these rates are going to increase, meaning that if it does expire, you're going to pay more. And what Trump and his team want to do is prevent this from expiring and keeping the lower rates. Now, you may be saying, well, what is this going to go up to? So the new rates would be this. The lower level, up to $11,600, it's going to stay the same. But then this 12% is going up to 15%. Next, 22% would go up to 25%. The 24% would go up to 28%. Then you have the 32% bumping to 33%. Then the 35% will stay the same, but then at the end, 39.6% would be the top amount. Now, you have to remember that this is a marginal tax bracket, meaning if you make $100,000 a year, okay, so if you make $100,000 a year as it stands, that doesn't mean that you're paying currently 22% taxes. What this means is, remember, up to the first $11,600, that amount of money, you're paying 10% of taxes. Then from $11,600 up to $47,100, that amount of income, you're paying currently 12%, okay? And then from $47,000 up to your current salary of $100,000, you're paying 22% tax on it. So the bottom line is that the way the current system is set up, the more you make, the more you pay in taxes. Got it? Now, the next thing that Trump is focused on, if he does get elected, is eliminating these taxes on tips. So this is great news for workers like bartenders, waiters, waitresses, who actually rely on tips for a significant part of their income, because now it means more money in their pockets without having to pay taxes on their tips from their patrons. All right. Third thing is this. He talked about increasing the standard deduction. Now, if you're not really sure what that is, what that means, basically the standard deduction is a specific amount of money that you can actually subtract from your income before you start calculating your taxes. So another way to think of it is like a tax-free chunk of your income that the government, can you believe this? The government actually allows us to keep. So for example, in 2024, if you're a single filer, the standard deduction is $14,600. And for those that are married filing jointly, the standard deduction is $29,800. Okay, so what this means is if you're single, okay, so if you're single, this one right here, and let's say you make 50 grand a year, you only have to pay taxes on, if you take $50,000 and you subtract, so if you take 50K and you subtract $14,600 from it, that means you only have to pay taxes on the difference, which is $37,400. So Trump's team wants to increase this amount, increase the standard deduction, which currently we don't know what they are. They don't know what they are. But again, by increasing the standard deduction, more of your income would be tax-free, which means you'd end up paying less taxes overall unless you itemize your deductions. If you do that, typically that is going to be more. The thing that differentiates it is, let's say the standard deduction is this. When you itemize your deductions, they come out to be 50 grand. Well, of course, you don't want to use this because 50 grand is even more. But if you itemize your deductions only 10 grand, then it would make more sense to pay whichever one is the higher one. Okay? So now that we talked about the taxes more for the middle class, now we're going to move into the corporate tax proposals. Okay? So an overall thing right now, corporations pay 21% tax rate. Okay? So that's what they currently pay, which was actually reduced from the Tax Cut and Jobs Act, 35%, okay? Now, if this law expires, the tax rate is gonna go from 21% back up to 35%. Now, Trump and his team, they propose keeping it at the 21%, which could be beneficial for businesses because now it allows them, again, to keep more money to invest in their growth. So now what I want to do is I want to break down to simplify this for you, because I think it's really important to look at it, because some people out there, maybe you, maybe some other people, they may own a corporation themselves. So you'll see how we're going to break this down, and we talk about double taxation, how this could really save you money. So let's break this down with a simple example. So I want you to imagine a company, and that company is going to be called Tech Corp. Okay. Tech Corp makes $1 million in profit, okay? And so at the corporate tax rate, remember the corporate tax rate was 21%? If we multiply $1 million times 21%, then this corporation is going to be paying $210,000 in taxes, all right? So after paying corporate taxes, Tech Corp has $790,000 left. So now let's say that the owner of Tech Corp is Alex. All right, and he decides to take this remaining $790,000 of profit as personal income. So if he takes this out as a dividend, he must pay personal income taxes on it, okay? And let's suppose his personal income tax rate, let's say it's 24%, all right? So at 24%, if you multiply 24% times $790,000, this is gonna be $189,000 in taxes. So after paying not only the corporate income tax and also paying the personal income tax, now he is left with roughly $600,400 left in this. Now, this process is something called double taxation, okay? Double taxation, because the profit, remember, the profit up here, the $1 million profit, is actually taxed twice. Once at the corporate level and again at the personal level, when it's taken out as income by the owner. So by keeping the corporate tax rate at 21%, businesses like Tech Corp can retain more money to reinvest and grow, benefiting both the company and if there's any shareholders in it too. So the next thing that we want to talk about is the proposal to actually decrease or cut down on the payroll taxes. Payroll taxes, if you get a check and you're an employee, you'll notice that you got some FICA taxes taken out. And what these are is payroll taxes fund Social Security and they fund Medicare. Employees pay currently 6.2% for Social Security and 1.45% for Medicare every time they're paid. And then that's employees. Now the employers, I'm self-employed, so not only do my employees pay this, then I have to turn around and I have to match this. I have to pay this as well in for them. So Trump and his team actually suggests reducing these taxes, which could mean, again, more take-home pay for workers and less financial burden on businesses. Now, what I want to do is I want to use an example of two dentists to really dive into this, to really solidify what this could potentially mean for both employees and employers. So let's talk about two different dentists. We have Dr. Smith, who makes $200,000 a year. We have Dr. Johnson, who makes $400,000 a year. So let's break this down with the payroll taxes. Remember, the Social Security tax was 6.2%. So 6.2% of they actually have a wage base limit. So for 2024, the limit is $160,200. So that's the most amount that you can pay currently whenever you're taxed for Social Security tax. So if you take 6.2%, you multiply it by 160,200. Actually, for both dentists, because his is even higher, 400,000. So you wouldn't do 6.2% of 200,000. You would do it at this base limit. It gets to be roughly 9,900 bucks. That's what they're going to be paying Social Security tax for both. Okay. Now, when you do Medicare, remember it's 1.45% of his salary. It's $2,900. So when you take this and you take this and you add them together, so the total that he's going to be paying is almost $13,000 in payroll taxes. Over here, again, Social Security was the same, 1.45% of 400,000 that he's making, 5,800 bucks. You take this and you add it to this, and you get almost $16,000 in payroll taxes. Okay, so that's the employee portion. Remember. So remember, with the payroll taxes, not only does the employee pay, but as the employer would also have to match this. So the employer would be paying this amount for Dr. Smith if these were employee dentists, okay, working for a corporation or something like that. Same thing, the employer dentist would be paying, matching this $15,732 for that. Again, Trump and his team, they suggest going in and doing something about this. They want to go in and they want to do payroll tax cuts. Now, again, while the exact reduction, it hasn't been specified, but it does seem to be that, again, if this passes, more money will potentially be going into the employee's pocket versus what is going to Uncle Sam. All right, now is the last part of all these proposed tax cuts, and that is taxes on foreign imports. All right, so let's talk a little bit more about the taxes on the foreign imports. Now, you have something called the universal base tariff. So Trump actually suggests a 10% tariff on all imported goods, which is actually aimed at increasing the cost of foreign products. Why? Because they want to encourage American-made goods. They want people to buy American. All right, so that's the universal base tariff. Now, there's a specific tariff on Chinese goods. So in addition to this 10%, they actually propose increasing tariffs on Chinese imports up to 60% or potentially even higher. So again, this substantial increase is intended, again, to reduce our dependence, America's dependence on Chinese products, and again, boost American manufacturing by making Chinese goods more expensive. So when you have something coming in, you know, I'm from Louisiana, and we're known for seafood, specifically crawfish. Now, if you go and you look at, you know, in the past, a package of frozen crawfish tails, it may be from Louisiana, it may be $10, but then right next to it is a package of frozen crawfish tails from China, could be like $5. That's currently kind of how it is. So what this is saying is it's going to substantially increase. So if somebody just wanted the crawfish tails, they're going to get, most of the time they're going to get the cheaper one. But if you raise that, instead of being $5, now it's $15 compared to the $10 from Louisiana, we're going to, you know, most of the time buy something that costs less. Plus, we're going to be focused on buying products that are from the USA. That's the whole basis of all of this, okay? So now that you know some of the proposed, if Trump is elected, some of his proposed tax changes. So what do you think? What do you think of the different changes that could potentially be passed? Do you think they'll help the economy? Do you have concerns? Do me a favor, let me know your thoughts in the comments below the section. I personally go in, I read every one of these. I will be the one, not a bot, not AI, but me. I will be the one that responds all to these, all these comments that you put in. Looking forward to seeing them. See you in the next video.